Welcome back, Alpha Hunters. I hope you all had a great week. The markets are closed for the week of March the 17th of 2023. So we're going to get into some things. I'm going to show off some different things. But if you're here for kind of like a little breakdown or overview of the SVB collapse that happened really last week. I think there has been enough information that has come out about the SVB collapse. I was able to kind of put together a little bit of an explanation, really kind of what happened. So that'll be a little bit later on in the video, but let's just kind of get into what went on this week on the markets. So this week had a nice little gap down from last Friday. Some of that was a little bit of a hangover. Saw the market buy it up. We had a lot of bearishness come in on the second half of last week, right after the SVB kind of fiasco. So yeah, Monday was not really a day that'd be good to be bearish, just because we had a gap down on already pretty bearish days last week. So it got bought up and it just kind of hung out. It did end the day a little bit negative, but not much. And then Tuesday, nice little gap up, rolled over for most of the day, especially in the middle part of the day, and then a nice little pump towards the end of the trading day. Wednesday then comes out, nice little gap down. Didn't really trade that much lower. Kind of sideways, really, mostly for the middle part of the day. And then a little pop and then sideways. Basically kind of ended that way for Wednesday. Thursday, though, we did have the ECB come out and raised rates by 50 basis points. Now, this was the day that I thought was a little bit more of a cautionary tale than any day this week. We saw ECB come out, raise rates by 50 basis points, and then the market went from basically down 0.5% or so to then rallying and being up a little bit over 1%, 1.5%. So I think it was roughly a 2% swing on Thursday from the low to the high, or a little bit over 2%. So it was just kind of an interesting day. The market was rallying on a pretty substantial rate increase coming from the ECB. So it's just kind of a crazy thing to think about, because about a week and a half ago or 2 weeks ago, if you would have said the ECB was going to raise rates by 50 basis points, what would you think was going to happen? You probably were thinking the market probably sold off, but it's not really what happened. We rallied pretty good. And then Friday, nice little gap down, probably giving back some of that and just rolling over and trading then flat for the last few hours of the trading day. So all in all, it was a very interesting week. Obviously, we had a lot of bearishness come into the market last week. We're going to take a look at some daily and weekly charts too. But yeah, Thursday's price action, it kind of caught me a little bit off guard, even as I wouldn't have thought we would be that bullish on that large of a rate hike coming from the ECB. So to me, I think Thursday's price action kind of even gave the Fed the go ahead to even raise rates by 25 basis points. I mean, because the market took it pretty bullishly. Taking a look here at sector performance throughout the week, we can see that tech, absolutely killed it this week. XLK, XLC, basically big tech was clearly leading the week, especially as the week pushed on into Wednesday, Thursday, and Friday. Big tech was definitely holding the ground. Then we had discretionaries also up there, utilities, healthcare, staples kind of in line, roughly around even with the market for the week. Real estate around that same area. Industrials, financials, materials, and energy kind of at the lower end of the week. Obviously, financials for many of the reasons that was left over from last week, and energy's got absolutely slaughtered here in the middle of the part of the week on Wednesday. They just got annihilated. And if you want to know why, go take a look at crude oil, and yeah, you'll see the chart absolutely drop off there. All right, taking a look here at the week over week change after last Friday's close to this Friday's close. I typically won't leave on here the expiration that just expired. This March 17th did just expire. I thought it was interesting to kind of leave it on. We did see a lot of selling of options this week, and I wonder if a lot of that had to do with how much implied volatility came out this week with the whole SVB thing earlier in the week and financials, because they were pretty volatile. So there was a lot of implied volatility just here on the short term. So just kind of wonder if we saw a lot of selling of options because of that. And we are getting past this huge expiration. That's kind of probably the biggest reason why I did leave this on here, just because we are getting past this huge expiration. And, we could see a lot of puts still being bought April 6th, a little bit more calls than puts, but a lot of puts being bought out here in April 21st. But as we've seen here over the previous couple of weeks, There's been a lot of put buying here on the April 21st options, especially on the put side. So the DXY, the dollar index for the week, is a pretty volatile week for many things in the markets. So we saw the dollar actually drop off, form a nice little Morningstar reversal pattern between Monday, Tuesday, and Wednesday of this week. But I didn't know which one was going to be more powerful. The massive selling that we saw from Wednesday to Monday in the dollar, or this Morningstar reversal. Obviously, the way Thursday, Friday look, it doesn't look like that Morningstar reversal pattern is going to be the one that kind of wins out. Currently, it still hasn't broken down these lows here quite yet, but if it does do that, yeah, that's not going to be good. Take a look here at the 10-year yield. Yeah, we saw a lot of volatility here around rates, and we'll look at that inversion yield next. But yeah, just every day, just huge moves. We hadn't seen moves like this as far as intraday, like this back to back to back to back in quite some time, at least not any time in the past few months. So it's been an interesting week to say the least. And I know a lot of things actually didn't move that far week over week, but they moved quite a bit during the week. And taking a look here at the 10 and 2-year inversion yield, this thing looks like it might have bottomed. I mean, this is a very strong move where, I mean, we had a very clear breakdown basically last week. And then this, at the end of last week, we got it to move back going towards the non-inverted area. And then obviously this week we had a huge move on Monday and then just choppy every day. And this was a lot of movement just from the 2 years. So yeah, a lot of things are being pretty volatile right now. So I wouldn't be trying to pick bottoms, especially in financials. So taking a look here at the GLD and gold, I would probably not be buying gold right here. And this quick move that we've had here over the past week and a half, taking out this high, I could see it, gold probably coming back down. I don't know how that kind of works into the dollar, maybe falling off or rising or what, but I mean, there's just a lot of sudden quick movement. If you're wanting to get in here, wait for a little bit of a settle out, and then maybe pick a spot, because right now it's obviously we got pretty extended here away from some of these moving averages. Wait for probably just a little bit better setup. I was really hoping we were getting a little bit more of a pullback, but then the SVB thing kind of really turned a wrench in a lot of those plans that were starting to develop very nicely. But it is what it is. It's just the market, and the way you got to deal with it sometimes. Take a look here at the bonds, the high yield side, at least the HYG. Not really too much movement over the week, just some volatility during the week, but really kind of flat week over week. So, I mean, we'll see which way it kind of goes, but these guys have definitely been a little bit more weaker than the LQD. The LQD has been a little bit slower, steady of an uptrend over the past week and a half or so. So you can tell people, trying to fill out a little bit more of that flight to safety, especially in the bond side of things. So we'll see how things kind of shake out here going forward. And then taking a look here at the VIX. Yeah, the VIX was just volatile all week, very much like some of the other charts that we just looked at, just ups and downs throughout the week. So I would imagine probably still going to see some sideways movement here on the VIX. I'm not expecting a whole lot of movement this week. I know we're going to have the FOMC on Wednesday. We'll get into that here in a little bit. But yeah, I would expect a lot of things to just kind of be choppy and be sideways. All right, taking a look here at the SPY chart. This is a weekly chart of the SPY. And really what we were seeing about 2, 3, 4 weeks ago, we were seeing some nice lower wicks kind of coming into that 390 area, the lower 390 area. And we were seeing buyers come in. That's why we were getting these lower wicks in there. The interesting thing is last week, we saw a pretty good breakdown. We did see a pretty good breakdown last week with SVB, and it really kind of started when we retested into this level. I did not see really the trading day on Friday of last week, but the fact that we closed down as hard as we did, all the way down around the mid 380s, kind of set up some pretty bad scenarios, at least going forward. Like the weekly chart doesn't really set up well, just because of how low we closed last week. Now, this week we had a nice upper wick. We retested into the lower and mid 390s, and we came back down. Okay. So basically we closed this week right on 390. I think we closed, yeah, 389.99. I mean, 1 penny away from 390. So retesting right into those weekly moving averages of the 10 and 20. And yeah, there's not a lot of, it's one of those situations where the market would need to get a weekly close back over 395, and really the higher the better. But I could just see the market just being choppy for now. There's a lot of risk out there, and I think SVB kind of exposed a lot of potential risk that are out there. And I know that a lot of people are trying to buy the dip, especially in some financial names, but there's a lot of risk out there, and we might just have seen the start of what could be something bigger later on. And I'm going to get into that right now. Okay, so I really hope you enjoy these cheesy professional kind of demonstrations of, kind of what happened. But it's going to be a pretty basic run through of what really kind of happened with SVB. Okay, so you have entities. Now, entities, I mean like people and businesses. Okay, and they use banks, and the banks use markets. Now, what really kind of happened, and what had happened over the past couple of years and several years, I mean, we've all seen this, where savings and high yield checking accounts, they really haven't been paying out to depositors, people and businesses that come to banks and deposit their money and kind of leave it in some of these accounts. They haven't really been getting, the best of interest rates, right? They've only been getting about 0.25% or something like that. It's something really low. So we all basically kind of know how this works, right? We deposit money, and the bank's going to give us some interest back, whether that's monthly, quarterly, semi-annually, or annually, whatever the terms are, they will do that. What the bank then does is they take your deposit and they go into the market. Now, by the market, I mean, loans, or they go buy bonds. They take the money and they go buy bonds. And if they can find bonds that are paying a better yield than what they have to pay out to their customers, like people or businesses, then they kind of make the difference. Now, if they're wanting to stay somewhat more secure, they're going to go with treasuries. Now, most banks out there, the reason why they pay such low yields on savings and checking accounts is because it's mostly meant to be a pretty liquid type of account, right? So if a bank is then going out there and buying or loaning your money out to somebody that's not as liquid, this is where the issue can kind of come up, okay? But what you need to just basically understand is the bank's going to take your money or take the depositor's money into the market, and they're going to try and find the best yield that they can, right? For many cases, they might go farther out of maturity. They might do loans that have a little bit higher yield, maybe more risk, but they're going to try and find the best yield that they can. Now, for just a very basic understanding of really kind of how bonds and bond values kind of work, is any kind of increase in rates, the bond value goes down. The tradable value of the bond goes down. Okay. Rates that go down, bond values go up. Okay. And the other thing about the bond value is the longer the duration of the bond, say like a 30-year bond over a 5-year bond, the more the value is going to be impacted the farther out the maturity is when the rates change. Okay, so that's also a key understanding here with the SVB thing. So with SVB, and really a lot of banks over the previous decade and a half, they haven't really had to have high yield savings accounts or checking accounts. It's been really low rates. So, and what have we really seen happen over the past year and a half? Well, we've seen interest rates really kind of rise quite substantially at that. And we've seen, people can now get a pretty good savings account rate of 4.5%. Now, are they getting that from banks? Maybe, maybe not. I don't really know. I don't really pay attention to what savings account rates are going for. But if somebody approaches a potential customer or a business and says, hey, if you move your accounts here, we can give you 4.5% on your savings and checking accounts. And you say, well, we're only getting 0.25% over at this other bank. And you just say, okay, yeah, we'll do it. You're like, all right, let's just do this. And you just initiate a wire transfer. Here's where the problem starts to come in. Okay. is the market rate for longer term bonds, like I was mentioning, has only kind of gone up a little bit, right? Because the shorter term rates are typically the ones that are a little bit more volatile. And since the shorter term rates have gone up quite substantially, they've gone up, a lot. And many of us, what do we know? Well, we know the yield curves are inverted. Like I just kind of talked about the 10 and 2 year and how inverted it is. And everybody's kind of been talking about this for months. And so when you have entities, whether they're people or businesses, saying, hey, I'm going to go get 4.5%, I need my capital back. But now the market rate is saying, hey, your bonds that you got, well, that market is trading at 3.75%, which is 2% higher from when you got into said $1,000 bond. Well, now those bonds are now valued at $650. So if you understand now $1,000 is not $650, you see where there's a huge discrepancy here, right? Because you've already told everybody that has deposits, hey, yeah, your value is $1,000 plus 0.25%. And then now when they come redeem it to say, hey, I want to go get 4.5%, but the value of your investments that you've used with their cash is now 35% less. This, in a nutshell, is essentially what kind of happened. A lot of people over the past year, especially like high wealth individuals that work at a lot of Silicon Valley companies or startups, a lot of these people had accounts at SVB. And as last year kind of went on, a lot of people started pulling funds, and that kind of has accelerated at the end of last year and at the beginning of this year to where they actually had to trade out many of their liquid assets to cover how much people were pulling funds. And since you're actually pulling it at a much more of a discount because you thought you were going to be able to hold it to maturity, but the maturity of the bonds that you were buying were much farther out, 10, 20, 30 years or so. This is where the risk in the system was kind of coming from an SVB situation. And basically SVB got into a situation where 3 of the current market value of the assets of bonds that they were holding from, capital invested from a year ago or even further back is now, covering 2 previous, valued accounts, right? So this is where you can get a very quick run on the banks. And it really kind of accelerated last week when essentially they issued an 8K, and in the 8K, they had put a footnote in the 8K saying if we had to take bonds that are currently in our long-term holdings. Now, this is going to get into some accounting kind of rules and regulations, but mostly they were accounting for their bond portfolio in held to maturity, right? And they should, because they were saying, hey, we're just going to hold these to maturity, not really understanding or not really thinking that, hey, people might pull their money. And in that 8K, they essentially said if we had to move money from held to maturity to our tradable account, we would take significant hits. And basically people saw that, and that's what essentially initiated the run on the bank and SVB. And if your question is, well, is there not a hedge for interest rate risk? Yes, there is. Did they use it? It does not appear as though they used one. So even though there are hedges out there for interest rate risk, it doesn't seem like they use them. And the other thing about hedges, they are not one-to-one. Whenever you try to use a hedge, it's not a one-to-one. It might be like an 80 or 90% cover, but it's not 100% cover. So even though you got a huge drop here in the value here, even if they would have used a hedge, it might have covered probably most of this to where maybe the total value between their bond portfolios and the hedge, it might have been like 950 or something like that. But that's a whole lot better than being down to 35%. Yeah, it's just kind of an interesting situation. It's one that not too many people have seen really ever before, to where interest rate risk has been that big of an issue. The last time we kind of saw this with interest rates was a long time ago, back in like the 40s and 50s. There's not too many people alive that were basically professionals then that could apply those lessons to now. So we're probably going to find just how deep the rabbit hole goes in this situation with the financial system as we continue to go on. But I got one last thing to show you. So this is just a basic kind of bond value calculator. I'm not trying to advertise for the site. It's just one of those just so that you can kind of get an idea really of what happened here and how much value can really change with bonds. Okay, we're looking at a 27-year kind of time to maturity bond. Okay, paying roughly a 2.5% coupon rate, and the face value, basically the value that you're going to get when the bond is redeemed in 27 years, would be $1,000. Okay, the current market interest rate. Now, I took this scenario and I used basically real numbers in that PowerPoint example I just kind of showed you. And I tried to use the best, most accurate numbers I could just to give you a very realistic situation of what we're dealing with. But the market interest rate, a little bit over a year and about 15 months ago or so, was about 2%. It was about 2% on the 30-year bonds, right? It was about 2%. So fast forward then and go forward 1 year, and you see that we have a 26-year time to maturity, still the same coupon rate, still the same face value. And you can see now that the market rate is at 4%. So a year later, the market interest rate has gone up 2%, and you can see the value of the bond now. So between last year at $1,100 and basically $3, $4, whichever, down to $760. Yeah, that's a pretty substantial hit. So this is kind of what a lot of banks are kind of dealing with. And I'm not saying there's a whole lot of banks out there that are at risk, especially with major capital risk. But I mean, there's a lot of a lot of bonds that have been massively devalued because of how quickly interest rates have risen over the past 15 months or so. And yeah, it's something that I'm not going to say it's going to bring down the market system or anything like that, but it is definitely something that you can just be aware of. So this next week, we're going to have the Fed meeting, the FOMC meeting, Wednesday afternoon. I will be starting a live stream about 15 minutes early before that. And, we will see what the Fed chooses to do. Currently, you can see that we're at about a 62% hike level with about a 38% no change, or basically they're not going to do anything this time around. And what's really kind of interesting is you can kind of see about a week ago, a little bit over a week ago, these numbers were really getting more skewed into the 50 basis point increase area. And then obviously, we had the fallout with SVB, and it has completely taken that off the table. We were kind of looking at this a little bit earlier in the week on the live stream, basically throughout the week. We just went straight to zero on a 50 basis point increase. And really, it's kind of been, the probability has been going back and forth between no rate hike and a 25 basis point rate hike. So we'll see which one we get this next week. I'm gonna probably just guess that they probably do raise a 0.25%. We do get that 25%. So that's just kind of where I'm thinking right now, and we'll see what we get. But just kind of think that they will take the opportunity to go ahead and raise another 25. I think they're going to be a lot more cautious about doing a 50 basis point increase going forward because they've already destroyed one. They've already destroyed a couple of banks out there. We'll see what comes. But yeah, probably going to be a 0.25%. At least that's where the market's leaning right now. So I'm not really expecting a lot of bullishness. I know there's some people on the live stream that they're expecting some bullishness, and I don't blame them. There's some bright spots out there, like tech was hugely bright spot of the week. If you want to take a look at the Qs just real quick, you just see them every day was just positive up until Friday. And not only were they a little bit positive, they were a lot of positive on Thursday. That's a little bit of caution for me. To me, it seems like it got a little bit ahead of itself. It seems to be maybe a little crowded for me. I want to see at least a little bit of a settle out. If the SPY can stop breaking down, the IWM can stop breaking down. IWM has been getting crushed. So we'll see. Really, it's a lot of the big companies in the SP 500, really in the top 10, have been holding up the SPY pretty good. Because if you look at the equal weighted SP 500, the RSP here, I mean, it was basically floating at the weekly lows pretty much 4 out of 5 days. Only Tuesday it was not. So yeah, I would say, it's kind of a top heavy spot right in here in the marketplace. So we'll see what happens, but I'm expecting probably just more chop. I wouldn't expect we break this week's highs or lows this next week. So that's just kind of what I'm thinking. Maybe we do break them. I wouldn't expect a hold either direction. So that's just kind of what I'm thinking. So yeah, we'll be taking a look at that on Wednesday, and a lot of that's going to be just contingent if nothing else breaks over this weekend. So we'll find out obviously on Monday, and as long as we can get to Monday and no other companies, especially banks, have gone bankrupt, then I think they'll probably do raise a 0.25%. Alpha Hunters, y'all take care. Have a great weekend. Alrighty, take care, Alpha Hunters.